Hey, you fellow traders. You guys have been doing a great job with helping out on the videos with the likes, the comments, the subscribes. Let's keep that up, keep it going. I really appreciate it because that's going to help the channel grow the most. And as promised, I'm going to start getting this video together and I'm going to try to get it up and posted and all before my computer does the worst case scenario. It has very vivid dreams of becoming a baked potato. So I'm going to try. I've got fans running. If you hear a little bit of a hum, that's what that is, trying to keep everything cool, so I can try to get this video made. I've got another one that should be arriving Friday, so I just gotta wait for it or pay an arm and a leg for something that's not really worth it. So I'm opting for the deal and just gonna have to wait a little bit for it, but patience is everything. But now in this video, this is going to be the second part of the support and resistance as promised. And what we're going to do is we're going to kind of work through this one together. If you haven't already checked out the first video, make sure you go back and check out support and resistance is not subjective. Make sure you watch that first because that's going to give you the basis of what we're about to do here. If you've already seen that video, great. I appreciate it. And let's go ahead and get you into the next part of it. Now, to do this example here together, we're going to just do the same pair. Probably have to upload this video again later as data progresses, but it will not change the actual process itself. So what you'll do is you'll go ahead and pull up Euro USD, and we're going to do this one together. Now, what you're going to do is you're going to actually go ahead and plot out your levels just like we talked about. Anywhere you see flat spots, anywhere you see some sharp points, and just go ahead and plot your levels based on all this. You can use any time frame chart that you like. I usually advise going with the daily, 4-hour, or the 1-hour. Computer is being very slow to respond to anything. Part of that is to do with the heat. But I generally do advise sticking to the higher time frames, but I know sometimes you may get into some slow action or you may get into where you see a lot of these levels. Even on the hourly you could see a lot of these levels, but just go ahead and pause the video, plot out all your levels, and then I'll give you a few seconds to do that, and then once it unpauses we'll go ahead and take a look. Okay, now if you ended up with something like this, which I'm sure some of you probably did, or something close to it, where you've got a lot of levels packed in really close together. And you probably just went and looked, and it's like, all right, well, there's a point, there's points, there's points, points. Now we got flat spots, flat spots. So if you come up with something like this, then I am going to tell you that you're absolutely correct. And the next part is how we're going to make adjustments for what we're trying to do. Now, the main thing to keep in mind is all these levels are going to be risk control. You're going to notice there's a consistent pattern between them. Now, the reason I advise doing the higher time frame a lot of times when you're starting out is because it's going to kind of filter those out for you. But another way that you can start filtering things is to figure out your actual risk that you want to risk and how long you actually want to wait in the trade. So of course a further distance is going to take a longer time to travel, and if you're looking to scalp, you're probably going to want to be on a 15 or hourly chart, or maybe even a 5-minute chart in some cases. And you can see where having these levels close together could be beneficial, because if you're trading here and you're starting to trade the New York Open and you want to get in here, okay, you can take a trade off of this level and know that, okay, that level is safe. You see it was clear, stayed clear, it traveled up. And we're going to get into this part next, but first we're just going to look at the risk part. So if you're using an easy pair, and if you're using like a USD currency based account, if you're using a 0.01 or 1,000 units, then each pip is going to be worth 10 cents. So you can figure if your distances are about 20 pips apart, that's going to be about $2 apart a piece. And it's something that you're going to actually multiply your size with depending on how much risk you want to do. So I'm always advising to look for something like a 1-to-1. And what we're going to get into now is your entries and exits. But if you were looking to, before I get into that part real quick, let's talk about if you wanted to uh, kind of trade over a longer term. You're not looking to scalp. You want to do a longer outlook, kind of similar to what I've been calling out with TradingView. Then all you would simply need to do is start eliminating levels that you've already cleared. This is going to be a natural filtering effect, and it will not only give you more time to actually figure out if you're correct or not in a trade, but it will allow you to take greater distances, which could give you some greater wins, and you could even get some drastic movements in your favor that take it even further sometimes. So this is one way it could work out for your advantage on the higher time frame. And the way I would start by doing that is first by taking a look at the highest point. And you'll notice I have the level kind of around this area here and not at the extremes of the wicks or anything like that. And the reason being is a lot of times that is your little bit of a working area. But notice how it kind of respected this area the most. You had a buildup of consolidation here, a buildup of consolidation here. You're getting some kind of wicks floating towards the top. And then you also get this little, what I kept referring to as a blip. And you can see that in a few other places where it's also something that I've referred to in the past as a x plus negative x equals 0. Or, you know, if you add a negative number to a positive number, then those numbers cancel each other out. That's kind of the effect of what's happening here. So you're just going to basically ignore this little area here. Let me set this up so it does what we need it to. So you're basically let's see if I can get it in front of the chart. There we go. So you're just going to basically look at this level as ignoring that, because that's where a majority of the price action is. Majority of your closes have happened, and it spent a lot of time there, and you've also got a very strong push down with that wick that also kind of lines up with this level. Now you could also say that maybe in here or here is a level, but if you're looking to manage your risk and get wider levels, you're going to start at the most extreme point first that you have set up. And another way you could do this is kind of look back. Notice that what we're looking at here on this level also lines up here. So you can actually figure that as being a fairly significant level. And then you can notice here that we have about 25 or so pips there, and there's about another 22 pips there. And that, if you kind of average that out, you get about 50 pips if you're skipping every other level. So basically, if you wanted to eliminate every other level, you could start there, eliminate here, eliminate here, eliminate here, and eliminate there. And then what I'm always talking about is, because you still have that pattern, you can literally measure this out, put it there, and look at how we're lining up there on this next wick. Okay, that's going to follow right along in that same pattern. Click to put your horizontal line. Now watch what happens when I do this. Notice the level. Notice the strong rejection wick. We've got a range there. We've got more rejections back and forth. Got a strong rejection there. It's showing you clearly where that level is, and it's lining up on pattern. So now, by using a little bit wider level on a higher time frame, then you can actually manage your risk a little bit more, give yourself a little bit more room for that trade. And look at that, another little lineup. It leaves those little extras, you know, like say we're gonna look for the most common area of where price is spending its time, and we may have a little bit down below, a little bit up above, but we're at an extreme here, so we're just going to kind of disregard that, but not fully. We'll get into that a little bit deeper, but notice it's not quite to a level, but if price does break this low, I would be willing to bet it respects that line. And if we went back, look at that. Look at how that lines up. So you're going to want to try to line everything up. You're going to want to ignore these little bits here and there. And then what we're going to do next is talk about your entries, exits, and kind of what you're trying to do overall. Now, a lot of people will lock into a certain time frame, certain time zone of trading, so on and so forth, but basically price is going to go where it's going to go. Just because the 15 minute says this, the hourly says that, the hourly says this, all these different time frames say all these different things. If you just look at price as a whole for where it's going, so let's even zoom this out, and then watch what happens. It's just the same as me scrunching it down. It's all following the same path, same line. It doesn't change what it does at all. It just moves it over and summarizes it more. So try not to think of price as moving in its own time frame, but as a whole overall. So if you're going up overall and you're thinking maybe it's a reversal here, and let's say normally, naturally, what you would try to do is you would try to enter short. I always kind of recommend just taking a guess, especially when you have these clear levels, because one, it's going to give you the best risk to reward ratio. Now, I'll refer to it as, having like a 1-to-1. So you're going to be looking for something like this at first. And then if it makes it back, but then starts to come back, you could actually choose to close it here, or you could hold and see, or close it at least halfway to that level. So this is another reason why I kind of advise a little bit wider level to give yourself some room, so you could actually run your stop above these highs or halfway between these levels where we deleted all those marks. And then if price comes back more than halfway, of course that trade is not going to go that way. So by stopping it there, that would be 1 unit of risk. But then let's say, all right, it broke up and you waited, it comes back, and now you're looking to go long. You enter directly at the level, put your stop halfway between, target the next level, and you end up with your 1-to-2. And even if you hit this 5 out of 10 times every 10 trades, that's going to make you money. So just by naturally using these levels, taking an educated guess, okay, price is moving up sharply, we've got a pretty good level here, just guess at a long trade here, take your stop below, or don't even use a stop at all, just kind of observe it. Because what could happen is, let's say you started to go long here, and it started to come back and breaks down, but now instead of going all the way to halfway down, maybe it's pushing back, but you see it's already kind of broke that trend line. You don't really have any confidence. You could actually close it up here instead of halfway down and lose less than your 1 unit of risk. So that's how you would use these levels to take your trades, take your risk control, and you can hit anywhere between 45 to 55% just naturally trading these levels, because these are about 50-50 either way. And if you add a little bit of observance of where the price is going, it's going to give you a little bit higher probability. So it's a lot easier to get a continuation than a reversal, and reversals don't happen extremely often. But occasionally, if you think it's going to reverse, a lot of times price will slow down before it turns. It's not going to instantly change direction. Now you could argue this is an instant change of direction, but that's a downtrend. So that's going to naturally happen anyway. So that's why if you were looking at something to sell off of this area, but then price kept going a little bit, you could still kind of hold and see what's happening. And then if it happens very quickly where it goes up and comes back down, well, that level would be considered a very strong level. Plus, it's already confirmed because it's been here before. It's already confirmed because it's been there before. This is the one thing that is always confirmed well in advance. Will follow that pattern, and even when you do not have any action above or below that area, just like we worked out here below, we actually took that off of our measurement, walked it down, and just plotted it out. And then you go and look back, and look right where we line up. We got that little nick right below it, and then it rejects up. So that's what we're kind of looking for in our levels. See, very small pass, and then right back to it. And then these in between, these little changes in between, those you just kind of have to take with a grain of salt. It's going to happen naturally. If you're in a downtrend, then sometimes it may not come back all the way to this level. And if you're in an uptrend, vice versa, it may not come all the way back down to this level. Notice here, it didn't come all the way back down again. Notice here, didn't quite reach back down to that level. But we're in an uptrend. Didn't quite reach all the way back down. Didn't quite reach all the way back down. So that's usually a good indication ahead of time that you may be continuing your trend, as if you're seeing that. Now, we could have this could actually play the opposite way here, where it got close to it this side, finally did reach it, but now we're showing that it's coming up short of it. But then again, it came up short here and did not. So these are some things to look at. Like in this case right now, I'm kind of looking to manage, and that's something we'll get into later. But first, your homework for this one is to go back and pull up a few more pairs, try to practice it out. You actually can go over to my channel. I don't have that pulled up currently, but you can view my channel. I've got quite a few calculators on there, or you could actually go to basically any Forex website, or just Google search Forex calculator. There's several different options, and kind of figure out what you want to risk based on your account size. I kind of generally say if you're doing a smaller account, you may want to do dollar-based, but a general rule of thumb is about 1% or so per trade when you're using a stop loss. And if you're going to scalp, I would probably recommend a 0.5% or 1/3% risk, just because you're going to be taking more trades, and if you're having a bad day, 1% risk on each trade could really tear your account down. So if you're scalping, I'd recommend using a little bit lower risk. But if you're going for the wider levels, you could even eliminate these in between here. Boom, boom, boom. Then you have this whole level here like this, which can lead you to believe that might have been a short, but then we break here. So then again, you have that short loss. But if it had gone right, you could hold to the next level. And generally, that's what you're going to be looking to try to do whenever you're in these trades like this. Let me see, boom, boom. That's the one that has to go, I think. Yes, and then that one. So you would just eliminate the in-betweens on the pattern in order to make it work there. So then you would just eliminate that. Now look, we've lined up right on the end of it. We've got our entire consolidation between this area here. So you could only be trading short from here, long from here, target there, give yourself this much room. So even though it shot past and come back, you could have closed it for much less. Then just waited and see if we're going short here. And these wider levels are going to come in handy when you're doing the management part, which we'll get into in the next video. But just work with your levels, practice, pull up some more, try to work them out, try to be patient and wait for those levels to hit, and then take your trade and try to target the next level below. If it is not working out or it's coming back on you, you can close it at break even, or you could just choose to hold. And if it does actually end up bouncing off it again and going finally, then you still win. But if it does break above, you can just simply close it out and lose far less than you're ever going to win. Then you end up actually growing your account that way. And all you have to do is make more than you lost, and that's your only job in the market. So you just have to find a simple way to do that, and this is probably one of the simplest ways I found to actually work that out. But once you actually get comfortable with what you're looking at, what your potential target may be, then that would be a level there. You just look for the flattest spot near the edge, ignore all the little points. and boom, look at that. So and just try to practice with a demo account moving forward, trying out different risk models. You can try back testing. I do tend to see a reduced effect. A lot of times it can give you a false impression of what you're actually doing, because it is much better, and you're actually much more knowledgeable about in the moment of what's going on, what the current news and situation is. So if there are any events back here, you'll get caught off guard with that, and it may throw you off. Whereas if you were listening to the news or knew what was going on right around that time, you may have been thinking otherwise. Whereas in your back testing, you may just assume that was going short again. So that can kind of throw you off in some ways, and then it's also kind of better to just see in real time anyway. It gives you a much better feel for the actual emotion and volatility of the market. So that's kind of my advisement. But to each their own. Some actually do pretty well with back testing, but definitely give this a shot, and forward testing on a demo account for sure. And that's how you'll really build up your confidence and actually get more familiar with how long these trades can take. So if I'm looking for, in this example here, about 80 pips apart, I could be holding this for 2 to 3 days before I see that target. But on the current trade, I believe that is the target. Let's see where we are here. Okay, so we've hit the second one. See, I was looking to come down there on the daily. I was looking for the breakout and come back to there. So still kind of managing that trade out, but that's what we'll get into in the next video. So just practice this for now. Kind of go back and watch it again just to see how we got to this point. But make sure you've also familiarized yourself with the last video in the playlist, just to make sure you understand how we're finding these levels. Try to lay it out basically as a definition of you're looking for a spot where price spends the most of its time, and I kind of show a few other examples there, and just give some practice. And then when I pull up the next video, we can actually do another practice session. I'll probably pick a different pair, but I won't tell you which one until we do the video. So just get that practice in, try it out. If you already had all your levels marked and they matched up with what I had at any point, then you did a great job. If not, just go back and practice and kind of look at things, rewind the video and kind of pause it, see where I marked all of my levels, and then go back and just kind of study how the chart looks on different time frames between the 5, the 15, the 1 hour, and the 4 hour. And daily. Usually the dailies will be your strongest levels, but they are going to be also be the widest ones apart, and you could be waiting forever in some of these trades. So I kind of suggest being around the 1 hour or the 4 hour, so you get a little bit more opportunities. Even if you're using a wide setup like this, you could get quite a few opportunities out of it. So I'm going to leave that for this video. Keyboard's starting to get just a little bit warm, so I'm going to have to shut it down, and I'll get this edited and up, and hopefully I can get it up here within a short bit. But go practice, and I'll see you in the next video.